Today, folks, we're going to talk about the Canadian collapsing bank sector. Well, not the companies themselves, but obviously their stock prices that are continuing to hit 52-week lows that are offering yields we haven't seen pretty much in the entire history of some of these banks. And the one we're going to focus on today is going to be Bank of Nova Scotia, which just hit a new all-time low, has an over 7.5% dividend yield. And we're going to ask ourselves, is that dividend secure? Is this a potential buying opportunity? As we also review all the other banks as just a broad overview from their dividend standpoint. And of course, we're going to take a look first and foremost at the Toronto Stock Exchange just to see what's happening this week. And if that is a conversation you appreciate, hit that like button because yes, the TSX is retesting its 52-week low. It's about half a point off from revisiting those October lows, the lowest we've experienced all year, primarily driven by this week the collapse in the banking sector. Yes, unlike the US, unlike big tech like Apple making up huge percentage of the S&P 500, we have things like Royal Bank and Toronto Dominion Bank being the largest aspects of Canada's, publicly traded companies. And it is pretty bad when in the top 10 largest companies in Canada, like Bank of Nova Scotia and Canadian Imperial, are down 4% in 1 week. It is going to materially impact the broader markets. Very intriguing stuff. If you are a bank-focused investor, I know a lot of Canadians love this BMO Equal Weight Bank Index, and this is like a true defining factor to the performance of the banks. And this has been probably one of the most resilient ETFs you pretty much could have bought over the last decade. And it's going to be questionable whether this is an opening opportunity for some true value discounts because, can the banks survive this recessionary environment? I mean, Bank of Nova Scotia over the last 80 years has never cut its dividends. So I want you to keep that in mind as they've survived prior inflationary periods, the dot-com, the '08 crisis, and so much more in between. And all of that kind of gets represented in this BMO Equal Weight ETF, ticker ZEB. It's got a reasonable, management fee, a little higher than usually I'd like, but 0.25 is not that bad with a starting distribution yield today of 5.44%, which is quite incredible with a monthly yield. Very cool stuff. If we take a look, it's always fun looking at it that if you invested $10,000 in this ETF, basically 10 years ago, that $10,000 today would be worth around $21,000. At the peak of the market, it would have been worth around $28,000. And taking a look, because it is an equal weight ETF, the only thing I don't pertainably like about these kind of ETFs is you could pretty much do this on your own, because there really are only 5-6 major holdings in this whole ETF with TD, National Bank, BMO, Canadian Imperial, Royal Bank, and Bank of Nova Scotia. So if you really just wanted to build your own bank ETF instead of paying this company a management fee, just equally weight and buy into the 6 major banks, or you could even maybe cut a few of them out and just do 4 or 5 of them, in my humble opinion. But the dividends on this are also astounding. The Canadian banks have been one of the most resilient dividend growth beasts pretty much on a global level, with a 10-year GIGR of 9.36%, probably only recently hindered perhaps by the pandemic where they kind of stalled out on doing dividend increases, but again, no dividend cuts. And if you want to see what that looks like, basically from a dividend income standpoint, like look at the growth in this. 10 years ago, you'd be getting around 6 cents a share. Today, you're getting around 14 cents, over a doubling of the dividend. Really, really awesome stuff. So where do the banks sit? Well, let's just kind of go through them real quick from a dividend standpoint, and then we'll fixate on Bank of Nova Scotia, because Royal Bank right now is reapproaching almost a 5% dividend yield. It is down 13% now year to date. And to put that in perspective, this is on the upper end of their yields. During the pandemic, they hit about 5.2%. And during 2016, they hit about 4.78. So where the dividend stands today at 4.91 is definitely something we don't see very often in this bank's starting yield. Now, Canadian Imperial, with a whopping 7.27% dividend yield, now down 12% year to date. Taking a look at where this dividend stands, yes, if we go back through history here, guys, this is pretty much higher than where it was during the pandemic and is higher than pretty much any time over the last 20 years that this company has ever experienced from a starting yield standpoint. I really want to show you this so it bakes into what an unusual market environment this is for these kind of starting yields. We've never really seen these before, and it's just very intriguing for those looking for income, right? So we have Toronto Dominion Bank with a 4.88 starting yield, is not retesting its 52-week low just yet, or its year-to-date low. It's only down about 10%, being one of the more stabilized performers here. And again, that starting yield at 4.88 is pretty much getting close, because in the pandemic, they hit about 5.19, right around 5.2. But again, throughout TD's entire history, this is an unusual period because they've never paid out yields that have been this high. Or again, starting yields, just keep that in mind. Even if we go all the way back to past 2000 here, there hasn't been really any time in history outside of 2002, probably coming out of the dot-com bubble, where it kind of started approaching these yields. So again, this is the first time in most of these banks' entire history on these publicly traded markets, and we're talking about 50 to 100 plus years of history. Look at Bank of Montreal with a 5.5 starting yield, down 14.5%. The yield history here on BMO, we can see that during the 2008 financial crisis, the stock collapsed miserably. The yield jumped up to 9.9%, and pretty much same during the pandemic level, even the dot-com bubble, this yield got well over 5%. So this is a little bit more common, but you look at how few times this has happened over a 20-year period, yet, even through all of this, they've been able to keep the dividend strong and steady and relatively increasing it through all of this. So it's kind of astounding to think that if any time you locked in some of these higher yield periods, you saw great returns and even dividend increases moving forward. But here we go, drum roll please, we got to talk about Bank of Nova Scotia, which is basically revisiting some of the stock price that it saw back during 2007 before the 2008 bust, and taking a look at the yield today, 7.47%, and obviously throughout its entire history, outside of the exception of the 2020 flash crash, we've never seen this high of a yield. And very similar to these other banks, even if you bought it during any of these kind of calamities, recessionary environments, you continued to see stock dividend increases, which is just wonderful, right? Like, these banks have been world renowned for these very reasons, to offer people stability. Now, the question is in this macro environment, is this still a true capability? Because what these banks are doing right now is cost cutting. They need to increase margins. They are putting loan loss provisions aside. And Bank of Nova Scotia joined many of the mega cap banks this week, basically cutting jobs. They're going to be laying off around 2,700 people, amounting to 3% of their total workforce on a global level. And that's going to cost Scotia about $590 million after tax, which is obviously coming into restructuring, severance, and consolidation to exit certain, well, it looks like, and they're going to exit certain real estate and service contracts. You got to remember, 2 months ago, RBC eliminated about 1% of their staff, or over 600 people. I'm planning to cut up to 2% of full-time equivalent staff over the next few months to reduce costs. So this is unlike something we've seen, but as mentioned, big companies have lots of margin to play with here, because when things start to get tough, they'll just trim the fat to make sure they are insured into the future. And we really just need to understand if these are enough measures to save them enough capital to get them through this recessionary environment, because something tells me it's going to be relatively short-lived. Something like 2008, when the government did the bailouts, I really cannot foresee this lasting for much more than the next 6 to 12 months until the inflationary cycle gets back under control. But is this dividend secure? That is the primary question I'm sure so many investors are asking themselves, because right now they're just kind of competing with provisions for credit losses. This is what is eating into their business, is credit quality degrades as people have to make larger payments against their loans. Luckily, Canadians remain well employed even with all these layoffs, and they are still continuing to pay the mortgages. Delinquencies still continue to be lower, and we won't really know until this quarterly report comes out, but people aren't defaulting on real estate. People aren't really defaulting across the board because the market is resilient. And if you can't afford your mortgage, you're still able to put the house up for sale, and people are still there buying it at decent market values to buy yourself out of your mortgage. So people that are struggling aren't going to be the result of the crashing market unless real estate really corrects. There continues to be resiliency and some cushion against the broader market and these macro events, but let's just ask ourselves, how safe is this dividend with the current earnings we have? Because we're not going to get big bank earnings till pretty much mid-end of November for this last quarter, which is why it's been really intriguing to see the US bank earnings, which again, the large cap US banks have been performing exceptionally well. Now, we're seeing the net income attributed to common shareholders about $2.1 billion, giving them an EPS of about $1.73 per share, hitting that bottom line. If we actually take a look at the dividend itself, they're paying out about $1.06, which is about $1.27 billion. So these banks have given themselves an amplitude amount of room to deal with these kind of environments, which is probably has what led to the stability over other recessionary periods in their dividend payouts, because they leave like almost 50% bleed room. Let's just take a look and see what BNS, according to Yahoo Finance, is currently paying out under their statistics. You can run the math based off the income versus the dividend payout, but according to this, it's about a 65% payout ratio. So they still have some bleed room to protect themselves. But what's also intriguing here is if you look at the valuation, it's nice the banks give you a book value, kind of similar to REITs. They do have like a net asset value, but we can see their book value as of their last quarterly report was $56.40. And what's really intriguing is through the past, their book values remain between $53 and $56 a share. Yet obviously the stock price, like NAV value, value never really reflects what the stock is doing. So if we take a look, because Bank of Nova Scotia is worth $56.68 today, so it is really getting close to its net asset or its book value. So we're talking about a very fair value play here for its underlying book assets. And we're talking about a company that probably still has some ample room to pay its dividend, even if it's got to do some layoffs, even if they have to write down some assets, which is something they just did on some of the Chinese assets. I think they're going to be writing down about $500 million. And a lot of this news sounds terrible, but in the perspective of, everything going on here, I think this isn't as bad as people might be making it out to be. So, I mean, there's a lot going on here that we have to review, especially on those next earnings. But I have to pass the question off to you because I truly believe that these may potentially be buying opportunities of a lifetime, especially for those looking to build yield portfolios. And my parents are heading into retirement. These are definitely things that we're considering. And as the year ends, these will be stocks that I will be purchasing within my tax-free savings account. I'm just praying to God that these opportunities persist at least for another 2.5 months. So fingers crossed for me. The longer I've been waiting, stacking cash has been playing into my favor, but that's more speculative in nature. But I'd love to know, are you buying these banks here?